now we're here to talk about winning in ventures. We'll start with some intros. Denika, would you like to kick us off?
Yeah, great. Hi, everyone. Great to be here. I'm Denika, partner at Cherry Ventures. Cherry Ventures is a pan-European fund, headquartered in Berlin, but with offices across Europe. I'm based here in London. We recently announced our Fund 5, which is a 500 million vehicle investing in companies from pre-seed to Series A. And we're hoping to back companies, businesses, entrepreneurs born in Europe, building for the world. So that's a short summary of the fund. I'm an operator turned VC, and so is all of the partnership and sort of everyone who works at Cherry. That's the quick summary of myself and the fund.
Fantastic. Hussein?
Great. Not that dissimilar. Also an early stage fund based here in London, investing across Europe. The goal is to invest in companies here that are in brand new market categories and then take them over across the pond into America. We had some early success with a few IPOs in our first fund. And then prior to investing at Hoxton, I was at Accel, which is another venture fund. And before that, I did 4 startups, all in the Bay Area.
Fantastic. So we're talking about category leaders, companies that have really been able to achieve something great, maybe being first in a rising innovation area, creating not only a new form of tech, but also the ecosystem, any of those sorts of things. Can you give me some examples of companies like that in your portfolio, and what made them stand out early on, particularly as you're investing at those earlier stages? Maybe Hussein, you'd like to start? Yeah,
so we had 2 kind of brand new market categories in our first fund, both of which went public. The first was a company called Deliveroo, which hopefully everyone in London knows because it's become iconic here. The new category creation, there was an old company back in the day in New York called Cosmo that tried to do deliveries. It was kind of early precursor to Instacart, except it was doing all kinds of deliveries, not just restaurant deliveries. And they did it with pager networks in the 90s. And you can imagine pager networks are not the greatest form of communication between the driver and headquarters, and drivers often get lost. And what Deliveroo came around and said is we'll kind of go basically build that same business, but using Android smartphones and GPS. And that's kind of the usher of why you can actually run a fleet at scale. And there's a lot of kind of operational tech kind of behind the scenes. And for us, that was a brand new market category because you couldn't do it until phones got really cheap and GPS was available. We wrote them the first check, and they kind of scaled exponentially from there. Now, we did a similar type of business in threat detection, which is Darktrace, which is a cybersecurity business. It's basically like a fancy alarm system for the corporate network. And today you would call it an AI company, but when it started about 10 years ago, AI was not the nomenclature that you used. It used as like Bayesian reasoning model. And the old version of this company did about $300 million in TAM. All the vendors combined kind of added up to about $300 million. And what Darktrace did was it said you don't have to write any rules, which is how the old vendors all had to do it. So you had to write all these like line items for what you were looking for in the alarm system. So if such and such happened, then the alarm would get tripped. And what Darktrace said is like throw away the entire rule set. We'll just self-learn automatically. We'll just listen to what's going on the wire. And if we see something suspicious, we'll kind of ring the alarm bell. That's kind of what Darktrace does. And then Darktrace at the time that it went private did about $732 million in revenue. So it kind of tells you how much bigger the market kind of expanded. And it was a fundamental technology shift. You could do that kind of computation at wire speed that you just couldn't do like 15, 20 years ago.
Amazing. It sounds like timing and the convergence of emerging tech coming together is really pivotal to those kind of use cases, right?
Yeah, I would say like in both of those cases, like tech was a big driver, but sometimes it's a regulatory driver.
Yeah,
and you
totally.
see a bunch of the challenger banks in the UK that have scaled up, like Revolut probably being the biggest, Monzo being the next biggest, that was because the regulators here, the FCA, kind of made it much easier to kind of be able to build a bank. So it could be any one of these reasons, but there's often a reason for why a new category gets formed.
Fantastic. Denika, would you like to share some examples?
Yeah, maybe one addition in our portfolio, a recent one, is a company called Amboss. So recently raised $260 million dollars. I would say they're a pre-IPO company. What they do, so they're a medical knowledge platform. The founders are all sort of, medical students turned doctors. And what they realized was that in their journey of, starting in med school all the way until sort of when you're a senior doctor, you needed to read sort of Bibles of information. Like every year, you'd need to upskill yourself multiple times a year. So new drugs, new white papers, and they couldn't find sort of the place to go that had this. They built it. They're a company in our fund too, born in Germany. They're now a Delaware incorporated company, 60% of their revenue is from the US. And they are sort of the gold standard in medical knowledge. So if you ask a doctor, and I have many friends who are doctors, Amboss is like the place where folks go when they're students to learn. But also I think why this platform is incredible is it stays with you through your life of being a physician. And so you have incredibly high retention in this product. And sort of why and how did it win? I think one of the things, obviously, it's a company that's been around now for 10 years. It's a scaled business for sure, but I think durable businesses do take time. And so that's an important thing, sort of not every company that we see in the news that has sort of the 0 to 50 journey in 2 years, that's not always needed in great company building. And then the second thing is founder market fit, right? Like these founders truly understood the problem that they were trying to solve. They were building a product for themselves, for their friends, and for basically everyone they knew who were yearning for this product. And we saw that to be sort of a winning formula in this case.
Yeah, I literally had an email from them yesterday. I haven't had time to write it up yet. Yeah, great company. So, I mean, both of you have portfolios where you include first-time funders, but also serial entrepreneurs. I guess, is there an advantage in being serial in this space at the moment, or can those, early-stage first-timers break out as category winners?
Yeah, we've seen a lot of stuff in our portfolio, and even just qualitatively, like in the industry, if you end up getting into the right market at the right time, and most of our founders, I would argue, are mission-driven entrepreneurs. So like when Will first set up Deliveroo, he was a hedge fund person who was so bummed out that in London you couldn't get food delivered the same way you could in New York. And when he came and talked to me in the early days, he said, "This is what I want to do post-Wharton." He was an MBA student. I was like, "This is a really bad idea. Like, you're going to make a lot more money in finance in London than doing this." And you understand that if you're going to be doing this, you're going to be jumping on bicycles, kind of delivering the food yourself, like for a good chunk of the time, because who knows how big this business can become. But he didn't go back into finance. He went and did that, and sure enough, like he was in the early days, he was the delivery driver for the company. And this is like a huge problem for him. So I think when you're mission driven like this and you've kind of found your calling, you found your company, sometimes if that company actually works out, that's kind of sort of the only real career you'll have. Like, and then maybe there's a precursor career to it in a little way. And so you don't end up going and building a second company or a third company as a serial founder. I can't imagine that Zuck is going to go build another company. I don't think Larry and Sergey are going to go build another company. They have some projects and they're investors in other things, but I don't think they're going to go in the trenches and kind of go fight another battle. But I think the alternative to this is the serial founders, you learn so much the first time you do something, and you get all this silly mistakes that everyone makes in terms of building a company, all these lessons that no one teaches you, there are no blog posts to read, you kind of ingest, and you're gonna not make those same mistakes again, so you're so much better equipped to be able to build a company. But I would argue you can't really figure out the timing of what greatness is going to be. And I think if you're mission driven, you're not doing it because you're trying to build a company. You're doing it because you're trying to solve the problem that you think the world needs solving. And that's what you're kind of throwing your life into. So serial founders, I think, make better founders, less risk, much higher chance of outcome. But the really, really, really big outcomes are probably the missionary driven first time founders.
Interesting. Did you have anything else you want to share on this point?
No, I think the only thing that we see repeat founders have a much simpler time raising initial amounts of capital, and I think in our industry there is sometimes a bias towards second time exited entrepreneurs. I mean, I know peers who, unlike Hussein and unlike us at Cherry, won't back first time founders, and so there is sort of a bias towards the latter, because they have seen it and done it, and sometimes seen greatness, know how to sell a company. So I think that's an initial advantage. I think repeat entrepreneurs do see. the initial hurdle of raising capital tends to be easier.
Yeah, makes sense. And so how do you both think about speed in the context that, there's two ways to go. There's, release your product fast and then iterate, or there's get your perfect market fit and get everything set up and the ducks in a row and then release. How do you think, what do you think works better if you're trying to go for this kind of first in the space?
Yeah, I mean, in my view and in Cherry's view, speed is a moat. Speed can be a moat, just like capital can be a moat, depending on what type of business you build. Speed is critical, and I think, particularly in the age that we're in today, where building applications, building software can be really easy, depending on what you're building. First mover advantage is incredibly key in some industries, but it's not a one-size-fits-all answer. Some problems are very hard, very deeply technical, require frontier technologies, and I think there's a market for both. So I think it really hinges on sort of what you're building, and how it needs to go to market, and whether it's an extremely competitive space for which first mover advantage is extremely real. Or whether you're building in sort of deep tech.
And we've seen some, first-timer companies raise ridiculously large amounts in AI, right? Which arguably leaves a funding gap for the incumbents. Is this something a trend that we can see restricted to AI over the incoming, short term, or will this affect all industries, do you think?
I mean, I have a very strong view that capital can be a moat. So I spent a lot of my years at Uber, a company where capital was extremely important as a moat, and arguably the most important moat was the amount of capital that we raised and could raise. However, I don't always think that that's the case. As I said before, I think it really depends on what type of a company you're building. Do you have any thoughts?
Yeah, I mean, I think VCs make really bad judges sometimes of like long-term durable businesses. And I think we are optimized as an industry far too often to think about funding momentum as a business. And so speed and momentum are like basically the same thing in this sense. And I think capital goes towards like the first movers. If you just take a step back, Facebook was not, now Meta, right, was not the first entrant in social networking. And like the early precursor was Friendster, got done by a bunch of venture funds in the US, never went anywhere, it was a little bit too ahead of its market. The big winner at the time was MySpace, which then kind of imploded, and they eventually sold. And then kind of Facebook kind of took over, and like very famously, like there was no real commercial business model for Facebook in the early days, which is why the investors wanted to sell it for $1 billion. And then Yahoo famously retraded on the deal, lowered the price of the tag, and Zuck was told by the board you had to sell at $1 billion, and Yahoo dropped the price down to sub-$1 billion. And so he told Yahoo to kind of go away and torpedo that. And then you look at where Facebook kind of entered up and where it is today. It's like a significantly bigger company than there's a $1 billion company. Google was a late entrant into search. There's a company in the construction software space that does about 600 million ARR called Procore. It took 13 years to get to product market fit. So, I am all about I tell a lot of my entrepreneurs, it's not how you start, it's where you finish. Like we had a very successful first fund, and Deliveroo and Darktrace are both in the first fund. Probably our biggest outcome in that fund, not necessarily by a market cap perspective, but from a return back to the fund, because we own a third of it, is a company that figured out its kind of product market fit in year 8. It survived all the way to get to year 8, which is good. And every single quarter, it's been doubling revenue. It's gone from like 100K to 200K to 500K to $1 million. These are all monthly numbers, to 2 million to now getting close to like 5 million. And so I think it will end up becoming just as big of an outcome for us as the other two were. So, and I think it's all where you finish as the company. And I think if you're trying to build these super long enduring companies, which I think aligns really well towards kind of mission-driven founders, it's the long journey that you're a part of. And I think VCs, unfortunately, we get our career progression, we get our press articles, we get our Midas list awards, all on a much shorter time horizon than decades. Yeah. And so we end up kind of veering towards the momentum side versus the long-term durable businesses. But if you're going to return a ton of capital back to your LPs, you want to be focused on the long-term durable businesses, not the hot flavor of the day.
And we know, to be a category leader, you have to expand regionally and globally, right? And how do you support startups through that? What kind of advice do you give them? I know you've got a founder program, so there might be some context in there as well you wanted to share as well.
Yeah, so I mean, a very small part of what we do is a program that we launched called Co-Pilot, which is a coaching program where we realized ourselves that coaching was a multiplier in our jobs. So we're thrown into these board meetings, or a founder calls me and says, I think I'm going to split up with my co-founder, or I'm very sick, or I'm pregnant and need to take time away from my company, and these are not sort of non-delicate, life-changing circumstances for founders. And what we realized is having coaching ourselves was a multiplier in being able to help our founders. And so we thought sort of, why aren't we supporting founders in sort of getting coaching much earlier in the journey than they think they would need it, which is probably slightly later. And so, yeah, I think that's helped and is a very core part of, I think, what we have seen is necessary in sort of the early roller coaster of company building. But to your point on sort of, taking companies to other countries or to other markets, it really depends. It depends on, when they achieve product market fit, when they're ready, how much capital they have. And so it's not a one size fits all. And we're ready to help support that, whether it's, moving and sort of going to market in Germany or another country in Europe versus the States. So.
Did you want to share any insights there, Hussein?
Yeah, I mean, we don't really, unfortunately, have very much on the programmatic stuff. We're just old-fashioned investors who are then just a pain in the ass on the board, and that's our value add. Yeah,
fair. I guess a question for you. I mean, given we're in this kind of geopolitical, economic shift, do you still think the US is a good market for European startups to prioritize?
That's a hard one, and I think the answer to that question changes week to week. I think at the beginning of this year, there was a euphoria in the US. I've made 6 trips to the US already this year, and I've got a 7th one coming up in a few weeks. I've been there a lot. Yeah. And most of our companies have ended up moving to the US. My board meetings are in the US. I would say there was a bullishness in the US ecosystem in January and February. And then we had that fateful discussion at the White House with our leadership and Zelensky, and it all kind of went sideways after that. And then it's progressively gotten worse. Now it's on Signal and it's really bad. And I just don't know is the honest answer. I would still say the US is still the big dominant market in the world alongside of China. And I don't think you can address the Chinese market from Europe. I don't think you can address the Chinese market from anywhere other than China. So I think it's really the US market that you're kind of playing for. And as much as I would love to believe Project Europe and things that are local here are going to change the narrative and we can build really great companies in Europe, I think most of the European companies will have to look towards the US to really be able to get to scale. And when you look at the number of businesses that got to 500 million plus in revenue, something like 75% of them get the majority of their revenue on the US side. So you can build a lot of valuation metrics in Europe and get really hot companies in Europe. If you're trying to build a revenue-oriented company, I think you're going to end up getting the bulk of that revenue from the US, which means you have to take it seriously, no matter how insane it looks like in the press.
Yeah. Any concluding thoughts? We've got about a minute.
No, I think the takeaway is resilience matters, and building for the long term is ultimately what we're playing for, and so what we're here, at least at Cherry, is trying to just support throughout the roller coaster, particularly in the early stage. But what we bank on is founders who are so ambitious that their ambition will help them navigate through some really tough times in company building, because it's never linear and never straightforward.
Yeah, tough times, but having support from VCs that are actually nurturing people in their growth. Fantastic.
Yeah, I mean, I think the hardest thing about the startups is, like, again, they need to raise capital to kind of survive. So, like, part of this whole ecosystem is you can be very long-term focused, especially as an early investor who kind of believes in the mission. But then these companies have to get themselves capitalized enough to be able to kind of go the distance. And that's the hard part and the nuance in this job, because the hot stuff is usually the stuff that has more momentum behind it.
Absolutely. Thank you both. Great discussion. Really enjoyed your perspectives. Thank you.
Thank you.